So yesterday there was a very significant sell-off in technology stocks, not specifically those that have been related to AI that have made huge gains in the last 12 months. So for example, SMCI, which was a darling for quite a while, down 24% yesterday. Nvidia down 10%, Broadcom down 4%, we have got AMD down 5%, Meta down 4%. So is this the end of the AI-driven bull market, or is this just a very healthy retracement before we see higher prices in the near future? Well, let's find out in this video. So yesterday we saw a big sudden sell-off in technology, AI-related stocks like, again, Nvidia, SMCI, and Meta, and Broadcom. So some people will be wondering, what happened to these companies? Or did everyone stop using AI all of a sudden? No, there's nothing wrong with the companies, and the growth narrative of AI hasn't changed. But what happened yesterday was plain old-fashioned sector rotation. So what does sector rotation mean? So if we take a look at all the stocks in the S&P 500, you notice that not all stocks went down yesterday. In fact, like I said, most of the tech stocks went down, but check it out. A lot of the healthcare stocks over here are in green, right? Healthcare went up, consumer defensives went up, in fact, financials went up, utilities went up, industrials went up. So we call this sector rotation, where money moves from one part of the market, from technology, moves out of technology and into healthcare, into financials, and then later you move back to technology again. So we call this sector rotation. So why does this happen? It's kind of like, imagine you're a guy or you're a girl, whatever, right? And you've got like 10 wives, okay, or 10 husbands. Now, can you pay attention to all 10 wives at the same time? No, you can't, right? So you can only pay attention to some wives at some times because you have a limited amount of energy, right? Okay, so you're paying attention to some wives and you're paying too much attention, they get overvalued, and then the other side gets pissed off, they're undervalued, they get ignored, they get upset. So once in a while you have to rotate back to those girls or those guys, and then you rotate back. So the market acts this way. And I don't know how many of you recall, but a couple of weeks ago, what happened was the opposite. Everyone was rotating to technology stocks, AI, and healthcare was ignored. In fact, if you recall, a few days ago, a lot of healthcare stocks, managed healthcare stocks, took a dump, right? So for example, one of my favorite companies, which I think is a fantastic business, United Health, it dropped like crazy about a week ago. All right, over here, can you see it drop here? Right, okay, and went way below the intrinsic value. So for example, my intrinsic value of United Health is calculated over here. I use my intrinsic value calculator to value all the stocks so I know what they are worth. And United Health, the intrinsic value is $565. And I draw it as a green line over there, 565, that's my intrinsic value. So once it gets way below the intrinsic value, I get excited, I start buying, all right? So what happened again last week was that sector rotation. Money rotated out of healthcare stocks. They were ignored, they were hated, and they went down, whoa, right? And so I started to accumulate these stocks, and I share this with my UIP, the Ultimate Investors Playbook community. They get my live buy and sell notifications every single day. Well, just to show you over here. Yeah, there it is, right? So 4th of April, you can see I added more United Health at 460. And I also added some Lululemon last week. And then over here, yep, I added even more on the 11th of April, added more United Health at 444. So I love to buy stocks when they are ignored, when they are out of favor, when money goes out of those industries, because then they get very cheap. All right. So the whole idea is to not chase the girl or chase the guy, those stocks that are flying. You wait for the girl to run to your arms, wait for the guy to run to your arms. So in the case of United Health, I was waiting for the girl, to run into my arms, and then I catch the girl, right? And so now the opposite happens. Now money rotates back into healthcare, and yesterday you can see healthcare, boom, starts to fly up, and technology goes down. So it's this rotation that goes back and forth. And as an investor, you have to take advantage of this rotation. Buy stocks that are out of rotation, okay? That's when they are cheap. And don't chase stocks when they are fully into rotation. So are stocks like Nvidia and, for example, SMCI, AMD, or Meta, are they now cheap enough? Are they now undervalued that we can start to, add more to them? Now, before I answer that question, I want to reinforce a very important concept to you. Again, I keep telling people that during a market correction, and you hear people like Warren Buffett say you got to be greedy when others are fearful. That's true, but you have to be careful to be only greedy to buy stocks where they are high quality companies, where their revenue and profits grow consistently year after year after year. These are the companies you want to buy, because these are the companies where after the correction, they will always go back to new highs. But the problem is a lot of people, they are greedy during a crash, but they buy low quality stocks, where these companies, they don't make consistent profits year after year. And these are companies that can drop and never come back. So it's very important to remember that you should only buy, again, the top 1% of companies in the world that meet all the high quality criteria, okay? And the reason is this. When you buy a company where, again, they're making more and more money every year over the long run, then you are confident, let me just draw it out for you, then you're confident that this business, over time, their intrinsic value, this green line I'm drawing here, this green line, this is called the intrinsic value of the stock. And again, this is something that I calculate every month. Every month I update the intrinsic value of all my stocks. And I do it for my UIP community where they can see all my updates. And again, if you want to learn how to do it yourself, you can always get my intrinsic value calculator in my investing course and calculate it yourself every month. So you know the valuation, all right, of the business. So again, a good company like Nvidia, like Microsoft, like Apple, like Amazon, or McDonald's or whatever, right? Their intrinsic value will keep going up for years and years and years, okay? So these are the companies that we want. These are the top 1% of companies. But again, does the share price go up every day, every week, every month, every year in line with the intrinsic value? It doesn't, because remember that in the short term, market price is driven by emotions, news, and manipulation. And there are times when the price gets way above. For example, when there's good news, when there's hype, when there's manipulation, the price can sometimes go way above the intrinsic value. And that is when it becomes very overvalued. It's like the rubber band, you're stretching the rubber band. And then when it gets really overbought, what happens is sector rotation, right? It will then find a reason, find a catalyst where, again, there's bad news, there's manipulation, and the price goes, and then goes way below the intrinsic value. And then the cycle repeats, right? It gets overvalued, undervalued, overvalued. So it's kind of like a pendulum. The market price is like a pendulum where it goes extremely optimistic, extremely pessimistic, up and down, but it's always eventually going back to this intrinsic value. So that's why knowing the intrinsic value is the most important thing, because once you know this intrinsic value, and you know that once the price gets way below the intrinsic value, I mean the lower the better, then that's when we start buying. Now, can we always buy right at the bottom here? Of course not. No one knows the exact bottom, right? So if the price goes below the intrinsic value here and you start buying, does it mean it'll go up straight away? No. Sometimes after I buy, the stock is undervalued, it can go even lower, which doesn't matter. You don't have to pick the bottom, because even if you buy here and it goes lower, who the hell cares? Because if you know that it's below the intrinsic value, eventually it's going to go back to and above the intrinsic value. You get the point? So I'm going to give you an example with Nvidia, and we look at Nvidia's intrinsic value. Why did the price drop? Very simple. Nothing wrong with Nvidia. It's a great company. The intrinsic value is still going to grow for years and years and years. It still monopolizes the GPU market. The reason Nvidia is starting to come down is simply because the share price got too far above the intrinsic value. So again, that rubber band, right, is beginning to now come back to the intrinsic value. So it's very normal. It's part of the entire cycle and game. So let's take a look at Nvidia as an example. Is it low enough below the intrinsic value? So over here, you can see I I just did a valuation, and again, I calculate the intrinsic value of all my companies every month. But you don't actually have to. You can do it once a year as well. That's fine. But I do it every month for my subscribers. So for NVIDIA, you can see that based on their latest free cash flow, their latest debt, their latest cash and investments, latest growth projections of the company and number of shares, yep, the intrinsic value is $709. Okay, so currently after the recent drop yesterday, it's at 762. So that means that it is still overpriced by about 7%, but it's coming to that intrinsic value. So over here, yep, you can see that. That's my intrinsic value, 709. And yep, it's still overpriced. So my discipline is to only buy it when it's below the intrinsic value, like what I showed you here on this chart. Buy it when it's below the intrinsic value. Now, I am not going to say that I can pick the bottom. No one can pick the bottom. It's like Confucius say, man who try to pick bottom only get smelly finger. Okay, so what I do is I buy in tranches. So once it drops below the intrinsic value by a certain amount, I'll start to add some shares, and if it drops lower, I add some more, I add some more, I add some more. So I buy it in 3 to 4 tranches to average in my position. So usually for every stock, I've got at least 4 buy levels, right? 674, 632, 572, and 520. These are all my buy levels that I determined by looking at historical support levels on different time frames. This is something that I teach in detail in my investing course. So for example, if you look at the weekly candles, I think it's a bit clearer. On the weekly candles, you can see where these are pretty significant levels of support. So for NVIDIA, I'm watching, waiting for it to go lower before I start, adding more to my position. Let's look at some others right now. So NVIDIA is still expensive. But how about Amazon, for example? So for Amazon, it's actually already undervalued. You can see my intrinsic value for Amazon is 182 intrinsic value, and now at 174. Yep, it's about 4.8% undervalued already. So it's really slightly undervalued, and it's going to reach this support level at 171. That's where I may start to add more shares to Amazon. Again, I already have quite a big position, but every year I add on to my high quality companies. So Amazon cheap. How about Meta? Meta has dropped quite a bit the last few days, and Meta is right now at fair value. You can see my intrinsic value for Meta is 480. So right now it is fairly priced. It's not expensive, it's not cheap, it is fairly priced. Okay, so I like to buy it when it's like below the valuation. So my first buy level I've identified, which is at a previous support here, previous gap, all right, is 453. That's why I'm going to add a bit more. And of course, if we can get back to 404, I'm going to buy like crazy, which I can't predict whether it will. I can't predict where the market will go in the short term. All I know is where I will add shares. And I know that in the long run, companies that their intrinsic value keeps going up, the market price going through volatility will always go higher. Let's take a look at one more example, Apple. So you guys, if you have been reading my social media posts, you know that I've been waiting to buy Apple for the longest time because it just won't come down, right? But now it's starting to come down. So my intrinsic value for Apple is about 168. Did I put it up here? Yeah, over here, right? So 168 is my intrinsic value, and it's been pretty resilient, but yesterday it's starting to come down. You can see a previous support over here, previous swing low. It's kind of like hovering at the swing low. So right now it is slightly undervalued, right? And I did add some shares, okay, because of that, but not too much, right? So I'm going to add more shares only if it goes lower to my lower support levels. That would give me a much better margin of safety, okay? Currently, my average price of Apple is 149. That's my current average price. So it doesn't have to go below my average price to add more. I don't mind adding more above my average cost as long as it's currently undervalued. All right. Now, the last thing that I have to mention is, again, please be careful. Don't just buy a stock because it dropped a lot, thinking that it's going to go back higher. You have to make sure it's a high quality company where the intrinsic value is growing over time. And I'm going to give you an example of one that isn't. And this company is called Transocean, which is in the oil and gas services industry. So if you look at Transocean, for example, and you take a look at the long-term financial results, are they growing their revenue in the long run? No, long run, you can see the revenue is falling, right? Revenue is falling in the long run, and the net profit is negative. They're losing money, losing money, losing money, losing money, losing money, losing money every year, right? So when a company is, losing money, year after year after year, or the profits are not growing, then obviously the intrinsic value is not growing. Now remember, when you buy a stock, what are you buying? You're buying a piece of a business. So always remember that you're not buying a lottery ticket, you're buying a business. And what is a business? A business is a money-making machine. It's as simple as that. The more money the business makes, or the more money the machine makes, the more it is worth. Correct? So if a business makes more money every year, then it's worth more. But for the case of a company like Transocean, it's not making more money every year. In fact, it's losing money every year. So for these companies, the intrinsic value is not going up. In fact, the intrinsic value could be going down every year, right? The intrinsic value is going down. Intrinsic value is going down because it's worth less and less and less, correct? So be careful, because in these cases, the share price will not go down in a straight line as well. The share price will go like that, right? So when the share price drops, you may think, oh, it's so cheap. So you buy here thinking it is undervalued, right? But it goes up and it goes back lower, right? Because it's not a growing business. And, I hear people say things like, Sophie, that's another very popular stock for whatever strange reason, right? But these are companies that are pretty dangerous, in my opinion, because they're not making money, right? So you look at that Sophie Technologies, which is a very popular retail stock. And yep, their revenue is growing, right? But they are losing money. They're still losing money, okay? So again, when a business doesn't make money, what is it worth? What is it worth? To me, it's not worth anything. Okay, I'm just kidding. It's worth something. It is worth what we call hope. Hoping that one day you'll make money, right? So when you buy a business that's not making money, you are buying hope. And of course, some hopes do come true and they may make money one day, but some hopes will never come true. So it's a question of how conservative or how aggressive you want to be as an investor. So to me, I keep saying to people that I'm a very conservative investor. So when I buy a business, I don't want to buy any kind of hope. I want to buy companies that have no hope. Okay, that doesn't sound very good. No, I want to buy companies that are actually making money. So I'm paying for actual profits. I'm not buying hope, all right? So be careful about that. And again, for example, if you look at Tesla, Tesla has dropped quite a bit so far. And I hear on social media, people say, oh, Tesla's really cheap, but really? Okay, again, if you put in their free cash flow, you put in all the financials, you'll find that the intrinsic value of Tesla is $131, okay? Again, based on a pretty optimistic growth assumption. Could be worse, but that's my valuation. So even though it's dropped quite a bit, it's still expensive, right? It has to go below 131 before it's undervalued. Now, some people would say to me, but Adam, you're not factoring in their robo-taxis, you're not factoring their Optimus robots and all, Elon can change the world. True, he could change the world. And in robo-taxis and FSD and the Optimus robots, sure, they could make a lot of money one day. I'm not disputing that. But the point is, it has not, right? So when you're paying more than what they're earning now, you are buying hope. Nothing wrong with that. I'm not saying that's wrong. But just bear in mind, when you're buying hope, hope doesn't always materialize. So just be careful. Now, again, finally, if I go back to this chart over here from Finviz, you can see again the sector rotation I was talking about. The last day, we have money flowing out of these three sectors and then into these sectors, because for the longest time, these sectors were unloved. the guy didn't pay attention to these girls, so they were getting pissed off, they were getting angry, so he thought, okay, I gotta pay attention to them. And then in the meantime, I ignore my beauty queens, all right? But eventually, he will rotate back to the beauty queens because in the long run, these are the beauty queens that will deliver the highest profits over the long run. Year to date, if you look at the year to date performance, you can see that, these are still the strongest sectors year to date. So hope you enjoyed this video, and as always, please subscribe and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.